Everybody, this is Rob Kientz with the Freedom Report, and I'm back with part two of the Precious Metals Masterclass. We got a lot to cover in this one. This is going to be part two or the middle part of a three-part series. I think you guys will be interested. Pricing, derivatives, and manipulation. Yes, I'm going to cover manipulation. That's going to be a lot of fun. But first, we're going to get into pricing and derivatives. And before I get into pricing, we're going to talk a little bit about the supply chain. You guys will see why we're going to do that here in a moment. This is part of a three-part series, as I stated. This presentation is the one in the middle, part two, pricing, derivatives, manipulation. Next time, to wrap up this masterclass in the third installment, we're going to talk about technical and fundamental analysis and risk management. I think part three may end up being the most important part of it because it really kind of tells you how to handle yourself within the space, gives you the tools that you need if you're going to invest in it, regardless of what level you're going to play in the field, and really arms you with the things that you need to know, along with the educational pieces in part one and part two I'm giving tonight in order to make the best choice for you. At the end of the day, this is for you to make the best choice for you, not for me to tell you what to do, but to educate you so that you can make those choices for yourself. And a little bit of update to part two and part three from part one, but I've added pieces to it, moved it around. I think there's going to be more benefit in the way that we're doing it this time. So without further ado, let's get into the table of contents, ladies and gentlemen, for part two. We're going to talk about supply and demand. We're going to finish up the supply chain piece where we move from mining, which was really what we detailed in part one, into the rest of the supply chain as it moves through the system to eventually get to your local coin dealer. We'll talk about metals pricing and how we calculate spot prices. I've got a very interesting study I'm not sure I've ever seen anyone give or talk about regarding some researchers who looked into spot prices and why that seems to be such a mystery. I'm going to show you why it's a mystery, and there's some very interesting revelations we're going to have on that, by the way, I've never talked about on my program before. This is going to be a bit of a new piece. I think you guys have followed me for a long time will love. If you haven't followed me, I think you're going to find the information also quite interesting, especially if you're coming from other markets, because there are implications of that to other markets, but we'll get into that here in a moment. We're going to talk about the derivatives because that's really where spot prices are determined. So we're going to break it down into the paper derivative trade and how that works. And then the biggest piece of it probably is going to be manipulation. And manipulation sounds like a big conspiracy theory, but I'm going to show you how manipulation has always existed across multiple markets. Basically, any market that's ever been open that's had humans trading it, there's been an incentive for people to try to steer that trade in their direction. That's basically what manipulation means, and we're going to go over that. Who controls prices? Let's move into the purpose of the presentation. Why are we doing this? Well, the questions that this presentation are going to attempt to answer the best that we can with the information available is, whose supply and demand are we talking about? Where do the numbers come from? What do they represent? How does metal move through the system from the mine to eventually getting to you? Do we know where all the metal comes from or goes to? Do we really have a tracking on every single ounce that gets produced and sold? What about private transactions? How do they play into the mix? Is everything run through the industrial markets in the US and UK? Or are there other ways in which that metal can reach the market, and who's taking that metal? What are the reporting requirements on sales, if any? How are prices determined, and who is moving the prices around and why, and what is their motivation and what is their benefit? You need to be aware of all of this, ladies and gentlemen, if you're going to play in the precious metals space. And the precious metals, of course, is a part of the commodity sector. So a lot of the research we're presenting applies to any commodity that you may be looking at, not just gold and silver, even though we're focusing on gold and silver for purposes of this particular masterclass. Supply chain of physical, as we get into section one. I've got a note here at the top. Metals are dug out of the ground and then sent to refineries for processing. We covered the mining process in part one, miners. If you haven't watched that prior to this, after watching this one, go back and watch it. There's a lot of really good information there on how geologists find this stuff, how they find economic deposits. And if you want to participate on the equity side in the miners, there's some guidance there, as well as some risk management principles for you at the end of that presentation you should pay attention to. We now pick up in part two the supply chain from there, and this piece, part two, pricing, derivatives, and manipulation. Now, this is a really cool image from Vaulted I've used before in presentations. And for the most part, it sums up how things work here in the US. You've got a miner or a recycler. Now, some of the stuff doesn't come from out of ground. It's already been used, and you take in some gold and silver and you recycle it. And it basically gets put at the beginning of the process because you're going to recycle it. So it's probably going to run through a lot of the same steps. Now, it depends on what type of recycling. If you're talking on an industrial level, it'll get put in at the refiner. If you're talking about like just scrap, like silverware or something like that, or old gold rings, a lot of times those get put in more in the wholesale place, wholesalers that do scrap melting and redevelopment of coins and bars. But in any case, usually when you're dealing with scrap, it gets put back further into the front of the supply chain to be reprocessed. It moves from a miner recycler to a refinery. A refinery basically is what takes something that's 90% pure, 85% pure, 95% pure, either in a Dory bar farm or a concentrate form, which is like a really concentrated dirt, if you will, that's mostly metal but has some other stuff in it. They'll refine it out. Why they do that is refiner it's very expensive to have the machines that get it to like 3/9 fineness of gold and silver. And so a lot of miners don't have that equipment. It's a huge capital expenditure. So there is a segment of the industry that specializes in that, and they're called refiners. Then it goes on to a mint. It could be the US mint, the Canadian mint, the Australian mint, the UK mint. It could be a private mint. There are lots of mints, sovereign mints, private mints. People that basically take the 3/9 fine or 4/9 fine product and mold it and shape it into some sort of product. Then it's transported. Sometimes it's transported overseas before it gets to a mint. Sometimes the mint produces it and then it's shipped off to another jurisdiction for sale. For example, if you're buying an Australian coin, well, obviously, it's probably minted in Australia and sent over here unless they have some local operations, which is a little bit more rare. A lot of times we'll export U.S. product to other countries if we're interested, like an American Silver Eagle or American Gold Eagle, very popular products worldwide. So sometimes you'll have a transport leg in there, but a lot of times you're buying your domestic supply. The most popular retail product in the United States, at least as measured by premiums, which we'll get into in part three, not in this part, is the American Gold and Silver Eagles. So definitely people will tend to adopt the coinage of the land, so to speak. So not all bullion is getting transported across, especially if you're able to refine and mint in your own jurisdiction. But sometimes there is a transportation leg. Then it goes to a wholesaler. Wholesalers are guys that take the finished products, they buy in bulk and then sell out to dealers, brokerages, depositories, banks. Back in ye old days in the US, you may buy your precious metals from a bank. Back when gold was money, or we were on the gold standard and you had gold and dollars trading side by side and dollars were redeemable in gold. That's not really the way it works anymore. So a lot of times you don't have a depository bank in the middle. You have a wholesaler straight to dealer, which is the more common pathway. But in some cases, there may be other intermediaries in there. You could have brokerages, or you could have firms that do like IRAs and they'll source from the wholesalers for you. If you're storing it with someone, it doesn't need to go to the coin store. It could go straight from the wholesaler to the storage company you're doing a deal with. So there are some variations to this little map that I have on screen. Just be aware this is generally all the players or most of the players that you would see, and just get an idea of how many hops it has to do. It has to take the gold and silver to go from ore to a processed product to minted to a wholesaler to eventually get to you. And that's why, ladies and gentlemen, while we're going to talk about spot prices on this presentation, if you're a retail buyer, you don't buy at spot, you buy above spot. Well, darn it, why would I buy above spot? Because spot's determined on the big industrial markets. And by the time it gets to you, it's got to go a couple of more hops, skips, and jumps. And so there's cost associated with that. Just the way all products work, from things from furniture, clothing, precious metals, and commodities are no different. All right, moving on. This is a really cool little heat map put out by Visual Capitalist, looking at 2022 production in gold. I just chose something that was relatively recent because of the way that the information is presented. Now, the first thing that you're going to see that South Africa really dominated the gold trade from probably about the 1930s till probably about 1990, 2000, when their trade started shrinking. They just started putting out a little bit less gold. They still have a lot of gold. They still certainly have a lot of the world's platinum and palladium. But relative to the rest of the world was starting to get into the trade. And you can see about 1990 where it really blew out. The US started creating a lot more gold from its local deposits. Peru jumped up there, Canada, Australia added it. And in 2007, probably the biggest thing to take away is that in the last 18 years, China overtook South Africa as the world's largest gold producing country, and they're still the world's largest gold producing country. Russia is just right behind. So you can see on this chart at the end of 2022, China had 330 tons, Russia 320, Australia tied for second place with 320, the Canada 220, the US 170, Mexico 120, so on and so forth. The other thing to note is this is just gold. We'll get to silver in a minute. When you take all the precious metals in hand, Mexico will pop up, Peru will pop up, especially in the silver space. And so some of these countries that produce more gold don't produce as much silver and vice versa. But this kind of gives you a neat little histogram heat map over about 200, 180, 200 years of production, just to kind of see the movement around of who is producing the most gold. I thought this was a really interesting chart. Who produces the most silver? Another one from Visual Capitalist, along with Vizsla Silver Corp. Shout out to Vizsla for great success in finding those big projects in Mexico. Mexico, as of 2023, according to Metals Focus and the Silver Institute and all those guys, was producing the most at 202.2 millions of ounces. Second place was China, 109.3 million ounces of silver. Third place was Peru, 107.1. If you look over there on the left of Mexico, you'll see the US pulling in at 32 million, Canada at 7.1. Russia over here by China is doing almost 40, Australia 34. So it's interesting to see that silver, the people that produce most silver most gold may not produce silver and vice versa. But China, Peru, Mexico all produce silver and gold. So usually where there's silver and gold and vice versa, although how much you produce each one really has to do with your local geology and the emphasis that administrations within each country puts on mining. So that can change from time to time. There are a lot of places in the Middle East, for example, that have a lot of rare earths and other commodities that haven't really been developed. Africa's still being developed. So these maps and these histograms will change over time. But as of, last couple of years, this gives you a really good idea of where stuff comes from. All right, supply considerations. While it would be nice to know exactly where all the physical metal goes to, not all transactions are logged or reportable because it's a physical market with lots of private contracts. This is particularly true when it comes to artisanal mines. Some artisanal mines go through Dubai, they go through other exchanges. Sometimes contracts are written straight to mines, whether artisanal or big professional ones, and it bypasses the industrial markets. And that supply goes directly to refiners to be put in bars and then back out in the merchants on the other side of the contract. Not all this is required to be publicly reportable. So we don't know exactly how much is used and how much is produced every year. We just ballpark it. And basically all of the companies that follow it will tell you that. We get kind of pretty close, we think, based on available information, but you're never going to truly know exactly how much is being output or used in products at any given time. We just do the best we can so that we can get ballpark numbers. And, at the end of the day, we just want to get an idea how much is out there. This is a really cool histogram from Voronoi, a visual capitalist putting out, I think this is 2023 numbers. You can see that there are some people that supply more and use less, and some people that supply less and use more. China puts out 378 tons in 2023, but uses 910, so they're a net importer. India is a huge net importer. They put out 15 tons of gold and intake 748 tons. So they're very much an importer. The US outputs 167, which is respectable, but imports 249. Turkey puts out 37. By the way, the third largest gold trading market in the world, and they put out a respectable 37, but you can see they're importing a lot. Okay, that's how they got to the third place in the world was they import 202 tons. Australia exports 294 and only uses 24. Russia 322 and 71. Just a good idea of the different types of gold flow. Some people produce more and use less. Some people produce less and use more. And that's where you get the world trade. This is an interesting chart on demand and usage from the World Gold Council. This is put together from a couple of different sources you can see here at the bottom. And I want you to pay attention to the colors on the chart. Well, actually, the first thing I'm going to point out is that we have relatively steady gold production quarter on quarter. This is a quarterly chart from 2010, quarter one to quarter three of this year. Some most recent numbers are off the World Gold Council's website. And you can see that even on the right-hand side, you've got the gold price. Even if gold price has risen from well below 1,000 to over 3,500 average price for the quarter, which will now be over 4,000 for Q4 when that information is available, it doesn't matter because we're still I'm sorry, demanding about the same amount or using about the same amount. So gold just keeps trucking along regardless of the price. It's very price inelastic, meaning the demand is going to be there regardless of what the price is. Well, what is the demand? If you look at the purple part of each of these bars, it's jewelry. Jewelry is one of the largest uses of gold. There's tons used in jewelry around the world, particularly in Eastern traditions in terms of 22 and 24 karat. More in the Western world because we like to inset various stones and things. We use 10, 14, and 18 karat because that's a mix of other harder alloys, which allows us to set in the stones and they don't fall out. 22 and 24 karat gold's a little bit softer and it can be used in jewelry, but usually not to place stones in it. So it's used around the world. Technology does, the blue bars on the chart, if you can see them, they're right below the purple, kind of hard to see, but there is some technology. Computer main boards is a main place where they use connectors, equipment connectors where you need good clean energy transfer and you don't want to use an aluminum or something else like that. You would, if it's a need for good clean energy, high efficiency, a lot of times they'll use gold. You've got investment, which is coins and bars that you and I buy, ladies and gentlemen. There's central banks, which is also investment, but it goes on the banking balance sheets and you can see who the main players are. It's interesting to note that investment between the central banks and private buyers, whether large or small, but still private buyers, has gone up quite a bit, and it takes up a bigger portion of the chart than it did, say, 15 years ago, where jewelry was a higher percentage. Now the green and the pink for all types of investment demand are higher. So there's been a lot of investment demand as gold has gone up. So there is a correlation between gold's price rising, and that's an indication of the strength of the worldwide economies or lack thereof, and the amount of investment that you get. And it's shown right here on this chart. All right, moving along. Silver demand and uses. This is really cool. Again, another visual capitalist, source metals focus with Vizsla Silver Corp sponsoring. You can see electrical and electronics accounts for a huge amount of tonnage. By the way, this is 1 billion total ounces used as of 2024. That's the best estimate we have. Note here, this special note, according to Oxford Economics, silver industrial demand is forecast to increase 46% between 2023 and 2033. A lot of that has to do with industrial use. Silver is a very industrial metal, much more so than gold. It's used in photovoltaics, which is like solar panels, other industrial, electrical, brazing alloys, investment, jewelry, silverware, and still a little bit in photography. If you ever use like a Kodak camera and you have one of those where you take the picture and you pull out, it instantly prints the picture for you and it takes a while to develop. A lot of silver is used in that. There are substitutes for silver in that, but it's still an important part of certain types of photography, especially not digital photography, but analog photography, things that's going to print to a film or to a picture coming out of a machine. And then, of course, investment is a huge chunk. So that's interesting information. All right. That was just sort of tying the rest of the supply chain together to give you an idea of once it comes out of the mines, what it's used for, where it goes, how much we produce, who's using it, to give you a good idea of the worldwide gold and silver supply and demand. All right, on to section 2, and this gets really fun. This is probably the area I would say in my 16 years of covering the commodities and the precious metals sector that is the hardest for people to grasp. And the reason it is I've got a warning here up on screen. Trying to figure out gold and silver spot prices can be hazardous to your health. Just when you think you've got it figured out, we learn that we really don't know how this is determined. And I've got an academic study for you. If you could just go and ask an analyst, a seasoned precious metals analyst will often tell you that the London OTC market, over the counter, and the US COMEX futures and options market are the two main Western markets, London being the oldest, and they determine the quote unquote spot prices for gold and silver. This is largely correct, we think, except that determining the calculus of how this actually works has been much harder than some other things, like finding out the secret formula for Coca-Cola, figuring out exactly how credit scores work, figuring out why we really need daylight savings time anymore, figuring out the college football playoff system. Those things I think are actually easier to figure out than it is figuring out what the true spot price of something should be, among one other of life's most vexing mysteries. And a thought that I want to leave you with here is, in all seriousness, we'll present to you the various data points with a healthy heaping of skepticism around whether the market makers really want you to know how it works. Because if you knew how it worked, it may take away their advantage. We'll get into that in a moment. There is a really interesting study out. This is a 2012 study, which, by the way, is printed out on the LBMA website, which is where you get the London OTC data. And on the next page, I'll give you a link on the screen that you can go read this study. There's a 2012 study of the gold market conducted by Dr. Brian M. Lucy and Dr. Fergal O'Connor, both college business professors and researchers on either side of the pond, as you will, and is reported by Dr. Charles Larkin in an LBMA article. It attempted to define which market between London and the US dominated gold market prices, and what they found is likely to confuse everyone even more. Or maybe illuminate something for you if you've spent as much time in this field as I have. They examined prices using two popular models. So they took some statistical models, which you could look at twin share prices, basically two markets competing in prices, and applied it to the gold sector. They used the Hasbrook 1995 model and the Gonzalo and Granger 1995 statistical models to look at a system of interrelated prices to deconstruct these into what they're called information shares. So in plain English, what they did was they compiled all the pricing data for London and COMEX. They threw it in there. They used a statistical method that's quite often used in these Siamese twin data sets, in which you have two data sets affecting a common share value like spot price, to try to see if they could find some sort of correlation. And then on top of that, they overlaid common factors that most people attribute to moving the gold price, whether it be a geopolitical event, a war, a currency crisis, an economic crisis, trade crisis, things like that, that people generally attribute gold price movements to. And they found some interesting results. Before I get to the results, I would like to point you to the graphs on the right-hand side of the screen. So the blue is the spot price in London in both of these different statistical studies, two different studies, two that have shown to have some ability to correlate two different prices in the same market. And then the gray is the New York or the COMEX. And as you can see, there's a very loose pattern. And when they, as you read the study, I didn't put the whole study here, but as you read the study on the LBMA's website, they tried to overlay these different geopolitical, war, currency, economic events. And they found that it really didn't have anything to do with who was dominating the pricing in the market, whether it be New York or London. The final paragraph from the study is very interesting, and I highlight some things I want you to pay attention to because it's going to feed into, as we get deeper into figuring out pricing and who's moving the markets. Quote from their study: the interesting aspects of the moves between New York and London are that they appear, except in examples of globally important phenomena, to be sui generis. What sui generis means is basically Latin for is not impacted by outside events, or is of in itself, meaning the market itself is determining prices. Key. The next question will be to try to understand, possibly via a behavioral or ethnographic study. So in other words, they're not looking at the common events that would move markets because they didn't find correlation to these. They didn't find correlation to wars or currency events or collapsing economies or whatever. It's behavioral and ethnographic, meaning human behavior. Whose human behavior? Let's read on to see. What are the key decision triggers for gold market actors in switching the locus of a price maker from one market to another, either the London OTC market or the COMEX futures and options market? In other words, what they're saying is, even though we all have thought for years and years and years, it's all these outside factors that affect who's determining the gold price. It's really not. It's outside factors that determine the overall general direction and trend of a gold price, not who's determining the gold price. It is the gold market actors that determine the gold price. Well, then your next question is going to be, well, Rob, who are the gold market actors? I'm so glad you asked. We'll get to that in just a moment. One other thing I wanted to point out was if you're going to COMEX, and I pulled this right off of CME Groups, who runs the COMEX. They're the administrators, if you will, that runs these markets, not only for gold and silver, but all the commodities for all intents and purposes, and futures and options. Um, we're looking at derivatives versus physical. It says right here off the CME Group website, our gold products provide global price discovery. Why would you need global price discovery if we roughly know supply and demand, we roughly know who's using what? Wouldn't the actual physical trade determine that? Well, not according to them, who happens to run these markets. There's opportunities for portfolio diversification. Listen, by presenting an alternative to gold bullion, coins, and mining stock investments. So wait a minute. You mean that the mining stocks that get it out of the ground, all the suppliers and miners and all that that develop the bullion and the products, whether it be the big 400-ounce bars all the way down to the sub 1 ounce, you mean they're not determining global prices? Well, apparently not, because the CME Group, which runs the markets over here, says that they're not. Ongoing trade opportunities. Gold prices respond to political and economic events. Gold prices. Gold prices. But remember in the past study that that's not actually true. It's actually the people trading on the exchanges that determine it according to that study, the gold market actors, not political and economic events. So CME Group is actually wrong. And I find that interesting that they're not correct about what determines who's pricing the gold and they're running the exchanges. I find that very interesting. Well, let's go on to another page of the CME Groups and this little snippet from their website. Look at this. There are trades equivalent of 27 million ounces a day, 30 times the gold ETF at 0.8 million ounces a day. The SPDR gold ETF, GLD, is supposed to be a 1-for-1 trade. You buy a share, and if you buy so many shares, it's equivalent to 1 ounce of gold. And the SLV to silver, right? That ETF. But they're saying they trade 30 times that. So they're admitting that this is a derivative. We all know it's a derivative. We all know it's a paper trade, and it doesn't have really a hill of beans to do with the physical trade. And it's just interesting to see that admitted on the exchange, which, by the way, seems to coincide with what the study said, and I'm going to give you more information on that as we go forward. So I just pulled, at the date of me compiling this presentation, probably about a day before you're going to see it, I pulled some statistics on gold and silver right off the CME Group's website. You'll see over here on the right, circled in red at the top, gold deliveries of 165 on November 11th. But the volume was 326,000 contracts. So that means that there were physical deliveries equivalent to 0.05%, not 5%. 0.05% of the overall trade was physical. That means that 99.94% of the trade was just paper trading. It had nothing to do with the physical. Now let's look at silver for the same day. Look at the interesting thing. Even though gold and silver are different markets, the percentages, and they have different numbers of volume, the percentages come out exactly the same almost. I mean, within one significant digit. Silver deliveries as a percentage of daily volume is 0.05%, 0.05%, 0.528. I find it interesting that gold and silver are different. We know that silver is more industrial. Gold's used in jewelry, but mostly it's used for investment. And yet the deliveries on one of the major exchanges of the world are almost mirror the same in terms of percentages of physical delivered versus a derivative trade. Could the gold market actors be trading these markets exactly the same way in tandem? I wonder, could that be the case? Well, this is just one day's worth of data, but I've been covering these markets for a very long time, and it's interesting to note that this happens quite a bit. So it goes back to the study we talked about, how the gold market actors have a lot of sway in determining the price. And I've got more data for you on that as we go through. I wanted to point out that sometimes on these markets, you're going to have unexplained price movements. Now, this is Tuesday, October 21st, 2025. I just pulled this off of TradingView. And look at this just sheer drop from 6 a.m. to about 5 p.m. It's a day's worth of trading. Gold fell $300. It was about 8% on the day, with little physical changing hands. How much typically changes hands? It's hundredths of a percent. And yet, how can the price change that much if there's almost no physical moving on a given day? Because it's the gold market actors, per the study, that are affecting the spot prices on COMEX. Very interesting. Through what? Paper trading. Ah, well, who are these mysterious gold market traders? For that, we go to the US Government Office of the Comptroller of the Currency. The URL to this report, which is printed quarterly, is down here. This is the one that I looked at, the latest one on their website. And we're going to give you 4 or 5 charts that basically show you who the players are. To do that, I want to set it up by saying what the OCC does is they look at derivative contracts by product. So you've got futures, options, swaps, and other derivatives. Now, this is for all derivatives. They're not singling out the precious metals here. However, when we get into who's trading, we know who the big banks are because they trade all derivatives across all markets, and that's clearly in this report. So this does give us an idea of the percentage of futures related to options and swaps across all products. And as you can see, futures and options are a significant chunk of the market, but swaps make up a much bigger chunk. And I'm not going to go into swaps here. There are gold swaps, the BIS, and it gets involved in that trade, but we're really focusing on futures, forwards, and options, which is how spot price is more determined in the American market. Now, if you go down to derivative contracts by type, this gets a little bit more interesting. Commodities is in red. You can see at the bottom, I mean, it's the second little section up from the bottom, and it's tiny. So commodities trading really is only a fraction of the total amount of derivatives in the world. A lot of it's interest rate derivatives. What is interest rate? It's basically a cost of money. Well, I mean, money makes the world go round. So it makes sense that you would have a huge amount of derivatives on money. It also means that the value of your dollar is also determined by what? Derivatives on the market for interest rates, foreign exchange, and that your equities, your stocks are also in here. So wait a minute. Stocks aren't just determined by one for, no, they're not. Interesting. Commodities and credit derivatives. Very interesting. So you mean the world's debt is traded, there's a derivative on top of debt. Isn't debt a derivative in and of itself? And we have another layer of derivatives on top. There's so many key insights this I'm not going to get into, but very interesting to see this report from the Office of the Comptroller of the Currency. 4 banks dominate derivatives. Now, futures and forwards make up, what is that, about $40 trillion? This is in billions of dollars. So it makes up about 40 trillion. The top 4 banks make up about, I would say, about 36 of 40 trillion, so about 90-ish%. The top 4 banks make up most of the swaps, most of the options, almost all of the credit derivatives. And of the total of all of these categories, it makes up, it looks like about 195 out of about 225 trillion, 195 and 225 trillion. So that's something in the high 80 percentages of all derivatives are traded by 4 banks. 4. So who are those 4 banks? Well, we happen to get that in figure 10. JP Morgan Chase, Bank of America, Goldman Sachs, and Citibank. So if you want to know who the 4 big banks are in the commodities derivatives and in all the derivatives, it's JP Morgan Chase, Bank of America, Goldman Sachs, and Citibank. Those would be, ladies and gentlemen, if we go back to this study, the gold market actors that are switching the price, the dominant price market from London to the US. Those gold market actors are identified by the US government as JP Morgan Chase, Bank of America, Citibank, and Goldman Sachs. See how we get there? You know, when you're researching this type of stuff to know how a market works, sometimes you just got to look in different places to put the pieces together. But it's very clear based on the public information from reputable sources. This is who basically determines the gold and silver prices, these big 4 banks across both London and the COMEX. Very interesting. Now, that doesn't mean that there aren't other big players in London, but it does mean there's a high correlation of these banks playing both markets and changing the price back and forth from time to time. Now, these banks aren't trading it all for themselves. They have big clients. The clients could be governments, they could be companies, they could be suppliers, they could be miners, it could be a bunch of different, and they could trade for their own book. But the point being, 4 banks basically represent the gold price actors, which determine the spot prices across the 2 major exchanges on the Western markets. That's the piece, that's the key piece that you need to understand. Now we're going to get to section 4. This is the fun piece on manipulation. I was one of the very first people to cover precious metals market manipulation. I started writing for Seeking Alpha in 2010. This is a screenshot of my little writers page on Seeking Alpha. I wrote for about 12 years. I haven't written them for them really in a couple of 3 years. I did for a long time. The cool thing about writing for Seeking Alpha, you got syndicated. I got syndicated to Yahoo Finance and Market Watch and NASDAQ and all these other places. It was great exposure, and that's really how I got started. I wrote a book, and then I wrote for Seeking Alpha way before I got into social media. So I've been doing this a long time, been commentating on the markets, analyzing for about 16 years. And the second, third, fourth, fifth, and sixth article I wrote, there's a 5-part series on gold market suppression. You can see 4 here. If you go to my, it's only 4 would pop up on a screen at a time, but there's 5. There's part 5 there. And the second, third, fourth, fifth, and sixth article I wrote were on manipulation. So very early in my career, I was on top of gold market manipulation. I was one of the first to report on it and any sort of mainstream media. So I've been following manipulation for a very, very long time. But ladies and gentlemen, I don't want you just to take my word for it. I'm going to show you a couple of even more reputable sources on that. And it's important that you understand manipulation because all markets are manipulated to an extent. And it's important that you understand that when you're getting in order to understand why things move the way they do and why it may be counterintuitive to what you think it would be because you're not the only player in the market. All right, we're going to focus on Jerry Markham. I've talked about him before on my channel. He is a specialist in banking, capital markets, and securities, commodities law and regulation, corporate finance. This is his bio page from Florida International University, where he's been a professor for a long time. But I want you to listen to his biography. It takes up 2 pages. This is how accomplished this gentleman is. And listen to his experience, and then we're going to get into his research. Jerry Markham is a prolific, nationally recognized scholar and proven classroom teacher in the fields of corporate finance, banking, commodities, trading, and securities regulation. His publications have been cited in over 600 law review articles and in numerous judicial opinions, including several federal district and appellate courts, as well as the Supreme Court of the United States. Yes, he's been cited by the highest court in the United States. Markham came to Florida International University College of Law from the University of North Carolina, where he was a tenured member of the law faculty for 12 years. Before that, he served for 10 years as an adjunct professor at the Georgetown University School of Law. In addition to numerous law journal articles, Markham is the author of a 3-volume financial history of the United States that was selected as a Choice Outstanding Academic Title in 2002. He also published a book on the Enron era scandals and has published a 2-volume work on the subprime crisis that shook the nation in 2008. Most recently, he had published a book on manipulation of stock and commodity prices and is a co-editor of a handbook on securities regulation. Aha! Continuing with his bio, Markham has co-authored 5 casebooks on corporate law and banking regulation. He has also published a 2-volume treatise and a history book on the law of commodity futures regulation and was a principal co-author of a 2-volume treatise on broker-dealer regulation. Before moving to academia, Professor Markham served as secretary and counsel, Chicago Board Options Exchange. It's one of those commodity options markets. He was the chief counsel, Division of Enforcement, United States CFTC. The CFTC is the regulator for the COMEX in the United States for all commodities. So he was in the Division of Enforcement for the regulator for commodities. So he would know something about the commodities trade and manipulation. He was an attorney, United States Security and Exchange Commission. That is, the SEC is the financial watchdog in the United States for publicly traded companies. And he was a partner of the international firm of Rogers and Wells in Washington, D.C. in law school. He served as editor-in-chief of the Kentucky Law Journal and was named to the Order of the Coif. So a very well decorated person that served in and around the commodities markets and is certainly an expert there. I would have brought you his curriculum vitae, which is basically his writing, his bibliography, but it was 11 pages. And he has 11 pages of books he's written, law articles, editorials, op-eds, other professional publications, court citations, including the Supreme Court, and quotations in newspapers and magazines. I just put all this out here to say that that guy would know what he's talking about. Now let's get into his research and see what it says on manipulation. This is a particular piece that he published that I've quoted before on my channel called The Manipulation of Commodities Futures Prices, the Unprosecutable Crime. Interesting. Let's read a section from his abstract at the beginning of the paper. He says, manipulation in the commodities futures market takes many forms. Prices may be manipulated through rumors or false information conveyed in the marketplace. Prices may also be manipulated through rigged trades or through capping or pegging, by which market prices are set at artificial levels for margin purposes, price setting, and other reasons. Highlighted in red. But the most significant form of manipulation is the market power manipulation. This type of manipulation requires large resources. Would that maybe be the four banks that trade most of the notional derivatives in the United States market, commodities and otherwise? I wonder if that's who you could be talking about. The trader in such manipulation is buying so many futures contracts in such large quantities of the underlying commodity that its market power is sufficient to create and sustain a manipulated or artificial price. Very interesting. One type of market power manipulation is a so-called corner, and he goes on to talk about corners and shorts and squeezes. But very interesting beginning to his paper, wouldn't you think, based on who we've determined who are the market traders as determined by the Office of the Comptroller and the Currency and that professional study done by two PhDs that are professors in the business world. Very interesting how we kind of put these pieces together and who really controls these markets as we're moving on further into his abstract, which is basically like his intro or the summary of his paper. The trader is seeking to create an artificial price by which he will profit. But here lies the rub. It's virtually impossible to determine what constitutes an artificial price. That's what makes investigation so hard. We'll get into that in a moment. Prices fluctuate constantly in the futures markets. Indeed, futures contracts are selected for trading on commodities that have volatile prices. Why? Because you can make money on it. Therefore, there is therefore no level of price that can be said to be a typical benchmark, non-artificial or true price. That's probably why that last study couldn't determine what affected prices, because the volatility of the market and the traders that trade it for their own personal benefit. You see, gold and silver, the long-term trends, yes, they can be affected by fundamentals, but this is proof positive that the traders determine where the markets go, and the biggest traders have undeniably the most effect on that. Very interesting. Coming down further, it says, but this economic analysis is so complicated and affected by so many factors that it's often impossible to determine what true price was. Further complicating the issue, the government and the courts have engrafted an intent requirement onto the prohibition against manipulation, requiring a showing that the trader intended to create an artificial price. Well, if you're just looking at computer data, how do you know the intent of the person that pushed the button if you weren't there and they weren't telling you their intent? Wouldn't that be nearly impossible to prosecute a crime of manipulation? Is that why his paper is called an unprosecutable crime? Very interesting. As a result, few prosecutions against manipulators have been brought, despite the fact that this prohibition is a centerpiece of the regulatory scheme. So in other words, the regulations aren't set up to really catch the bad guys. Moreover, even when prosecutions are brought, only rarely significant sanctions are imposed upon those found to have engaged in manipulation. Moving on to the opening paragraph of his study. Manipulations have plagued the national economy since the inception of future trading over 100 years ago. This is not a current phenomenon, ladies and gentlemen. But congressional concern with price manipulation and abuses did not lessen as a result of the creation of the CFTC in 1974. To the contrary, events such as the silver crisis of 1980, the stock market crash of 1987, and the battle in the soybean pit in 1989 between Ferruzzi Financiera, sorry if I said that name wrong, and the Chicago Board of Trade have continued to give rise to concerns that futures prices are susceptible to manipulation and price distortion. And it's been going on for 100 years? Very interesting. These concerns are very real because under present law, the crime of manipulation is virtually unprosecutable, and remedies for those injured by price manipulation are difficult to obtain. Moreover, even where a prosecution is successful, an investigation and effort necessary to bring a case will involve years of work, enormous expenditures, as well as an extended trial. Ooh, so the odds are stacked against the manipulators from getting caught, never having to do anything about it, like restitution. Last part of a study that I want to read to you. It's very important. We're going to go through the whole thing. The history of manipulation in the commodities future industry dramatically underscores the fact that regulatory efforts on the part of the federal government have been unsuccessful. The wheat kings were almost entirely unregulated until the 1920s, when the Grain Futures Act was adopted. That legislation, however, proved unsuccessful. Thereafter, the stock market crash of 1929 and the precipitous decline in commodity prices resulted in the adoption of the Commodities Exchange Act of 1936. This regulation also proved to be lacking in effective regulatory measures to prevent manipulation. Among other things, it failed to define manipulation and it failed to prohibit particular manipulative practices that could be easily prosecuted. Because of these shortcomings, complicated investigations and extended litigation were necessary to prove manipulation. As a result, cases were often settled with de minimis sanctions, meaning not much. And when a matter was litigated, the government's proof or theories were often found lacking. The split in the circuits between Volkett and Cargill caused further confusion, and efforts by the government to eliminate that confusion through legislation proved to be unsuccessful. You keep seeing the word unsuccessful and unprosecutable. It's no wonder that these big foreign market makers can really do what they want in the market. Very interesting. This limited legislation, adopted in 1968 to give the government additional powers, also proved ineffective. Later, with the explosion of commodity prices in the early 1970s, Congress created the CFTC and granted it what appeared to be broad powers to deal with market misconduct. Are we making progress? Well, let's see. This included the authority to impose civil penalties of up to $100,000 and the authority to take emergency action. Those powers, however, proved to be ineffective. This is well illustrated by such events as the potato default, the assault on the soybean market by Hunts, and the silver crisis of 1988, the stock market crash of 1987, and other episodes described above. The CFTC also inherited the existing difficulty of proving a manipulation case. As a result, it has only brought a limited number of cases, often with limited success. Aha! Well, there was one such case in 2020. JP Morgan Chase & Co. agrees to pay $920 million in connection with schemes to defraud precious metals in U.S. Treasury markets, almost $1 billion of defrauding two markets. Who's JP Morgan Chase? Wait a minute, wasn't it one of these big four traders on the market? Oh, it was, according to the Office of the Comptroller of the Currency. And they're one of the big four traders, which allows them to manipulate more, according to Jerry. And they are one of the gold market actors that determines which market is determining price. So they determine what the market price is, they move the market around, and they're hard to catch. Boy, I find all that very interesting. What about you guys? All right. I'm going to fast forward to where I was. Moving on. Well, not to be outdone, I had the opportunity in 22, myself, and I, to interview the former deputy director of the Office of Enforcement in the CFTC about his experience investigating commodities trades at the Silver Symposium Conference in Idaho. And I'm going to show you that in a minute. It's interesting that if you look at his LinkedIn, I just copied this from his LinkedIn. He lists as being the Deputy Director, Office of Enforcement Surveillance Branch of the U.S. Commodities Futures Trading Commission through December of 2020. So he would have been the guy of record to conduct this investigation when JP Morgan was busted. So this guy knows what happened to JP Morgan more than anybody else. And I got to interview him. And we're going to take a look at that. Now, I'm not going to play the video for you, but this is his presentation at Silver Symposium. I just screenshotted one part of his presentation I want to read to you. He's admitting, as a former investigator, the lead investigator, that his personal beliefs, based on experience from being at the regulator and doing these investigations, are that every market can be manipulated. Someone will likely try to manipulate the market or product to gain at some time. He doesn't think it's done every day, although he can't prove it either way. And with data, every abuse is uncoverable, meaning even with data, even with the data, you can't figure out all the abuses, and even trying to prove them and get some sort of ruling is hard because you have to prove intent. How do I know that? Well, I asked him. This is me interviewing him at same said conference, a Silver Symposium in 2022. I think his interview went about an hour and a half. It was very fascinating. I did 3 videos on my channel about it. You can go to my channel at this link below and get the first video. And if you go there, there's a playlist which has all 3 of these in a row, where I basically take the presentation, the video presentation from my interview with him, and his preceding presentation done right before this, where we talk about manipulation. But I'm going to summarize you what I learned from that. There are other key findings I learned from that, but these are the interesting ones. He's confirming what Jerry Markham wrote in his paper. Remember, Jerry Markham was the lead counsel for the enforcement division. He's the investigative division. What happens is it goes from investigator, him, to people like Jerry Markham in enforcement. So I've got either side of that investigation covered here in this presentation, straight from the horse's mouths. He told me during that conference and everybody else in attendance that the CFTC does not have sufficient personnel to watch all the trades. They had 12 investigators at the time of his leaving in 2020, down from almost 70 when he started due to budget cuts. And I said, okay, how good is that? And he said, well, to review trades on the 1,000 products at COMEX trades, more than just gold and silver, we're talking all commodities, he would need 1,000 investigators, at least one for each, because you can collect all the data, but you got to have a person sifting through. I would tell you from having been an investigator, I have a master's degree with a concentration in digital forensics, in which I was taught forensics work. Based on the complexity of these trades, you would need more than one person. So having 1,000 people to watch this, humans, in addition to the data collection, is probably on the light side, if I'm taking a guess, based on my experience, 30 years of corporate audit and investigations, different types of investigations that I did. His investigations went to another group within the CFTC where the determination would be made on potential actions on a trader, and he did not have direct visibility, meaning the the investigation was handed off to enforcement, and then whatever happened, they were just, they couldn't see behind the curtain, so to speak. He did not believe the CFTC had appropriate resources to adequately monitor commodities markets. Already covered that. The CFTC has data detection engine for trades, but they need human investigation for each case as they have to prove intent, which is very hard to do. I can tell you from dealing with big data sets in cybersecurity and audit that you can have as much data as you want, but the big data can make things harder because you got to sift through it. You got to figure out how the pieces fit together. And AI, even AI at this point, is not competent enough to do that for you. Humans are still much better at it, and it takes a lot of resources. And when you graft on the intent where you have to prove humans' intent, but all you're looking at is the data or the metadata around a trade, it's very hard to do that. That's why you don't see those fines come all the time. And that's why the markets are going to continue to be manipulated. It makes sense. It confirms the finding of Jerry Markham's research in the commodities market. So we've come full circle. All right, ladies and gentlemen, we made it through part two. I'm so excited. That is so awesome. So glad that you stuck with me through this part of the presentation. Hope that that wasn't too long for you guys. We've got part three coming up. Part three, I'm going to get back to pricing, and I'm going to take you from spot prices to the prices you pay at your dealer. I'm going to talk about premiums. I've got a lot of historic data that, thanks to a good friend of mine in FinTech who put together some nice charts for us, available on the public interwebs. And then I'm going to talk about different products and how premiums on different products really go up and down on the products you like to buy, depending on what's going on in the market, what's going on in the world, what's going on with all these market makers shifting around gold and silver prices on their derivative trades. And then probably the most important piece, I'm going to talk about risk management. I'm going to talk about risk management because no matter what trade you get into, it helps to you to understand the risk of what you're getting into. If you're getting on the front side in equities, you want to know what the risks are. I did cover risks in that presentation, but I'm going to cover it more broadly across all precious metals investments for you. I do this for you. Okay, one thing I wanted to point out, a lot of influencers or people on social media aren't going to give you this type of presentation because it would seem to subvert their ability to influence you because you're teaching them how to think for themselves. But I'm not your average everyday influencer. I'm the guy that wants you to understand how all this stuff works because I'm here for you because I'm one of you. I'm one of the people, and hopefully this has been helpful. Hopefully part two has been helpful to you, and hopefully part three will wrap it up in this masterclass series and really give you the resources that you need. It's all free, ladies and gentlemen. Just go to my channel, go to the Live from Vault channel. It's being put on both of them to reach a wide audience, and hopefully you found this helpful. Till next time, this has been the second part of the three-part Precious Metals Masterclass presented by Robert Kientz at the Freedom Report.